quick run through of this is we see that on this side here, this is a downtrend, right? We see the market in a downtrend, and we know this as an uptrend. Why? Because the market is going up and the market is going down, right? Very basic things that I hope many of you guys in here learned based on the free course that's on YouTube. So the most important part of market structure for us in this discipline is these yellow boxes. You see the lows and the highs, right? Anything that's happening in between really doesn't matter to us. What matters to us the most is those yellow boxes, the boxes that highlight what the high is and what the low is, right? The reason why they're important is because where they are happening matters more than just them happening alone, right? What goes on in that box. And we're going to explain that in a few. But where these highs and lows are placed are oftentimes within what we call zones. Now, zones are within the previous highs and lows. So what we see is in this downtrend, we put in a low, then we put in a high. And what do we end up doing after we put in that high? We break back below that low. So then we put in another low, and then you see another high get put in. That's called a lower high because that high is higher than it's lower, sorry, than the previous high. So what we have is a higher low, lower low, and then another lower low on the bottom of it. We have a lower high and then another lower high below it, right? So we know that price is still going down because it's not creating any highs that are higher than the previous high. That's our idea of when price is getting ready to reverse and go to the upside. But there's little nuances in that that I'll explain a little later. So what I mentioned was that these highs and these lows are perfectly placed within previous highs and lows in past price, right? Previous ranges. That's what we consider them. So that's what we call zones, right? We have this zone. What is a zone? Well, price put in a low, it put in a high, and then it traded back below that low. So our zone is that previous range that we have there, right? So it's not from the high that's up here to the current low that's down here. It's from both the previous highs and lows. So we should already be caught up with that because that was taught in the free playlist, right? So the most important parts to us in this entire dynamic would be the highs, the lows, and the break, right? So where each high happens, where each low happens, right? Remember I said where it happens, right? Not what's happening there, it's where it is happening. And I'm going to explain it to you guys like this. So if we go over here to the left, every high and low that we see inside of here, let me move some of this out of the way. Every high and low that we see inside of there starts with this. It starts with, as we are trading higher from this low that's down below here, we put in these bullish candles to send us higher, right? So what happens at this high here is that we trade below a previous bullish candle, right? So this has 3 bullish candles on the way up, and then there's a bearish candle that shows up and places us below that bullish candle that's there. So now, while we are below this bullish candle, does that mean that price is ready to go down? No, because a lot of the times when we get below that bullish candle, what you see is more bullish candles begin to form to take us up again, right? To take us higher. This down move right here is how lows are placed. And when we trade back up above it, that's how we know when the market is getting ready to trade higher. It begins to trade in the current direction of the trend. So a lot of the times when we see the market trading, higher here, right, we're looking to get involved in an entry on a breakout. We want to see price go higher. We want to see price trade up above like this, right? But what we end up doing is getting caught in chasing that high because we don't know where the low, that higher low, is going to be placed. So when that higher low gets placed, that's when we should be looking for opportunities within here to now take price higher. It's on that pullback, as we call it. So as we are trading up above here, we see the pullback begin to happen. At the top of where this pullback begins to happen, that yellow box that you see up there, what's happening is this particular thing to the left that we just drew out. We get the closure below the bullish candle, the body closure below the bullish candle. And then we begin to see price resume and trade higher. But as we mentioned, this low that's here oftentimes is perfectly placed in what we call a zone, right? So if we go back to our example on the downtrend, let me just get rid of this. If we go back to our example over here on the downtrend, we understand that as price trades up above the previous lower high and it puts in a higher high because it's higher than the high to the left that it just broke, now we're anticipating price to trade back down. Now, what you might see is people take a Fibonacci, right? A standard fib. Let me just find one here. People take a Fibonacci and they'll draw the Fibonacci out here. Let me remove this from the top. They'll draw the Fibonacci out and they'll expect price to trade back into what they call the golden zone of the Fibonacci, right? The 61.8, the 50%, even the 70%. They're expecting price to trade back inside of there. And then from here, they're expecting price to continue. Now, while there are times where price will reach back into this Fibonacci, this Fibonacci level, the 61.8, the 50%, while we understand that price at times reaches back in there, it does not always go back to that 61.8%. It does not always go back to the 50%. So what we actually use here is when we do get that flip, we use this zone, right? The previous range, as we discussed. The previous range is when price breaks up above that old high. And what we take is the high and the low of that old high, right? That's both the previous high and low. We take that as a zone right here, and we place our Fibonacci around that zone, right? With this fib, it's the 30, the 50, and the 70 on it. So it's 3, 5, and 7, or 0.3, 0.5, 0.7. So we take that and we're anticipating for price to get into that 50%. And then we want to see what at that 50%? We want to see this, right? Right here. We see that price trades up above that old bearish candle to the left. It trades higher than it, and it puts in a body above the old bearish candle, not a wick. So there are some times where we see a wick that will trade down below that bearish candle, and then you'll have price continue higher, right? You'll see something like this. We'll see price continue higher and trade up like that. would this be considered a high? To us, in what we learn here, no, that is not considered a high. We have to get the body below the bearish candle, sorry, the bullish candle, in order for it to be considered a high. That means that it could be one candle. It could even be multiple candles trading below that, right? You could have a few candles down here. And then we begin to see this move trading back up again from here, right? Let me just get rid of some of this so it's not as messy. What we can see is price stop here and then begin to trade higher up above, like we see over here. But what we need to validate this particular high here is a closure below. That lets us know that a retracement, this retracement right here, this box at the top, we know that a retracement is potentially getting ready to occur when we get that closure below that candle. Now that retracement can be of any size. That retracement can just go back to this 30%. That retracement might go to the 50. That retracement might even dig further down into here and hit that 70 before it actually trades out again. But what we're looking for is, if we are bullish and we're expecting price to go higher, what we need to pay attention to is price trading back into that range, back into that previous range, back into the 50%, or there are times where it hits that 30. We need to have that. So we're not looking to, we get this breakout, now we're looking to take price long, right? Because then we could end up in a considerable amount of drawdown down here before price actually trades up again. And there are times where this candle, as it's retracing, it may just go all the way down to the low. And guess what's happening there? When it trades down to that low, all it's doing is breaking the previous low, moving back into that range. And now while your entry was up above here, and you might have no stop loss, you should trade with a stop loss. I'll always recommend trading with a stop loss no matter how advanced you are. What you end up seeing is price trade lower. And now it's creating lower highs and lower lows to the other side, while you were trying to get involved in the breakout, or while you were trying to get involved in some imbalance that was inside of here to trade higher, what we end up getting was a break lower. Now, there are some things within the mandatory material that you guys have within the mentorship to where you'll have some idea of whether price is going to stop here or whether price is going to go all the way down here, right? That's in how to trade using the 30 and the 70, right? There are little subtleties that will show up at these areas that'll let us know if price is getting ready to trade lower or if price is going to hold here and then move us higher again. So that's why it's very important for you guys to watch that video. But this is the crux of market structure, how we use it. So that means that, as we mentioned, this here is what the yellow boxes are to the left, right? This low here is what the yellow boxes are to the left. So as we trade up here, that's what's happening there, right? As we put in a low down here, that's what's happening there. So all it is validating our pullback, right? Now, what is the pullback? Is the pullback a retracement, or is the pullback a continuation? All it is pulling price back to the opposite direction that it's slated to go in, right? That it's intending to go in. So when we get a market structure break, what we have up here on the break is this. We close below that bullish candle, and no matter how far down you see us go down here, right, where we're going to stop oftentimes is inside of that zone, But not only is it inside of the zone, what we need to see is this happen right here. We need to see that closure up above that previous candle to let us know that now it's ready to trade higher. So this is going to happen in almost all of the zones that you see. So as we begin to trade lower, what you see over here is there's that previous zone to the left. Price taps into the zone and continues down. Here's the same thing. The previous zone to the left. Price hits the previous zone, hits the 30% of it, and what does it do? It trades down. Here's the previous zone to the left. And what does price do with this? Price doesn't respect it. Now, there are times where price can go right into it and trade out, right? But it fails to put in a new low. That failure right there should let you know to get out of that entry because the market is slated to go against you. The market likely is going to break the high of that zone. Why? Because this zone ends up being too weak to put in another low, so we end up taking out the high of the zone. Right? When we take out the high of that zone, now that is where our flip occurs. And what we're looking at when the flip occurs is that previous range right here. So this is where we start drawing out zones as it's trading higher. So you have your break right here, and then you have another down move, and then we have a break that's here. We have another break that's here. We have another break that's here, right? We have another break that's here. And every time we break up above this high, we are anticipating price to do what? We are anticipating price to give us this right here and then move us back into that previous zone that we have here. And when we get back into the previous zone that we have here, what are we anticipating price to do inside of that zone? We're anticipating this to happen here, right? This to happen right here. So this is what these yellow boxes are. These yellow boxes are the most important part of understanding market structure. It's helping us to time properly when the market is set to go lower and when the market is set to go higher. So this is the most important part, as I mentioned, of this entire dynamic, right? Letting us know when the pullback is going to occur and letting us know when the continuation is going to occur. Now, if the market moved as simple as this, we would all be, billionaires, right? Trillionaires. It'd be so easy, right, to be able to trade. Because all we had to do is wait for this closure and then we trade down with it. Wait for the closure and we trade up with it. But the truth is, this is how the market actually moves, like this. So if I can overlay this on the current price action that we have here, now it looks a little more difficult. A little more difficult to follow, right? Because we see all of these highs and lows in here, and now it's not looking like the simple break up above, tap back in, and continue. Now we end up finding ourselves confused with which high and which low is actually the pullback, right? And this is where you hear people talk about internal highs and lows, external highs and lows, right? Now, I don't really pay too much attention to internal and external. What I more or less look for is swing count. You guys hear me talk about that a lot. And as we go further in, you'll see why. So now this is how it's actually looking in real time. This is the way the market actually looks. So before it was a little pretty, right? Oh yeah, we can just wait for the closure and then we go back in with it, and then we can just wait for the closure again, and now we know where to short down. But guess what? Now these yellow boxes you see here, these yellow boxes are happening everywhere. So as we mentioned, if price moved the way we initially explained it earlier in the video, what we would see is that everyone would be able to enter into the market and become millionaires and billionaires, right? But this is why I consider swing count above everything, because when we see this as our measure for whether price is going higher or lower, what we have to understand is that this is happening in every single high and low on the 1 minute, on the 5 minute, on the 15 minute. And it does not necessarily mean that price is actually ready to reverse. Remember what I said, it matters about where this is happening, right? So if I can take this yellow box here, I could show you guys that this happens everywhere, right? Almost every high and low, we're going to see this same thing occurring. Every single high and low that's present here. So that's a lot of stuff to keep track of. It happening here. What if I go short here and then it trades up? Okay, what if I go long here and then it goes down below it? But then it happens again there, and it happens again there, and it happens again there. And the entire time, while I'm thinking that it's bullish and trading higher, I'm buying down here because of this criteria over here, and it's just constantly going against me. So the solution to that is not to buy every single closure you see, but where the closures are happening. That's the most important thing. That's the low here. That closure occurs, and then we trade higher. You're going to see multiple closures here and here and here and here and here, and even here and here and down there again too, and there and there and there and there. That's going to be happening all the way down to make you think that price is ready to trade higher, and it's not. This is going to be happening on the way up and make you think that the price is looking to trade lower, and it's not. So it's where this occurs that matters for us the most. The number one thing you want to make sure is that whenever you're getting into a trade, it's in a zone. What did we call zones earlier? We call zones the previous up move. Price previously traded up above and then went back below its former low. Now it put in a new low, right? And what we're looking for is price to trade back into that previous range. And here is where we look for this in order to say, okay, now we're looking for price to trade lower. But what actually happens inside of there is that you end up getting something like this. You'll see price trade inside. Sorry, you'll see price trade inside and put in a high there, right? And you think it's ready to go down. And what will actually happen is it'll trade up again, up there. And then that's when it actually moves the other way, right? So this particular thing here, this retracement that we're looking for to occur, we get the down candle closure. We're expecting price to continue down, but what actually happens here is it occurs here where it brings us down, but then it trades higher again up above. And now when it brings us down here, it just runs, it just leaves. gives us no opportunity to get in, and it heads straight back for the low. Or there are times where it doesn't go straight to the low. There are times where it will consolidate inside of here before actually turning around. So this is why with this dynamic, with us closing up above the previous candle to believe that we're retracing or going bullish, for us closing below the previous candle and think that we're retracing and going bearish, what we have to understand is that this can happen anywhere, right? Where this needs to happen matters more than it happening on its own. Price can continue to go up and not be inside of a zone at all and do this and then make its way up again. As I told you guys earlier, price can just put a wick through that previous low and then continue to make its way up. And just because you see this red candle form and we begin to trade down does not mean that's time to slap in a trade there, place my stop behind the engulfing or all the different names that they have out there, and then look for price to continue down. While that happens sometimes, it doesn't always happen. We're looking for where this dynamic happens in order to set us up to take the trade we're looking to trade and have the outcome we're looking for. So this is the true nature of the market. You'll see this happen. There are times where it may just tap here and go straight down. There are times where it moves higher and then goes lower. There are times where another high can come out of it like that and then actually trade lower. What matters the most is that you are in a zone, right? You're in a zone. Now, the homework that you guys get that's going to help you to fine tune your ability to time this in the zone, but the zone matters the most, right? When it comes to timing properly those highs and those lows that we're expecting to occur. So, again, on the way up, back on the way down, on the way up again, on the way down, on the way up, on the way down. We're going to get this particular thing everywhere. It does not mean price is ready to go long or price is ready to go short. It just gives us some intention on what price could potentially do. But there are a few other things that we need to see happening, like structure, the narrative of it that's happening around that. Some zones do not hold, and there's a narrative that price will show us to let us know that the zone is not going to hold. Then we have zones within zones. Those are things that we teach within the free playlist, right? But we refine those zones within zones to models that we use within the mentorship. So those models are giving us the detail of the zones within that zone that we're able to take trades from and reduce our risk. Because if you're taking a trade from this larger zone that is here, right, your stop generally is at your entry is generally at the 30 or at the 50, right? And your stop is behind the high, or some people place their stop at the 70. There are times where it may go from the 30. There are times where it may reject from the 50. There are times where it may come all the way to the 70 right here. And that would be where your stop is behind here, and then actually make its way back down. Now, the models will give you an idea of where price is particularly going when it gets back into the zone. But you will learn these things over time, and you'll learn how to properly refine your entries to where you don't have to risk the entire zone that's there. You can risk a smaller amount to be a part of a larger move leaving. But the very first thing you need to understand is market structure, right? These highs and these lows that are being put in, right? This is something that you need to pay attention to, because your trades are always going to go against you if you're trading against the overall trend in the market. This here is the actual downtrend that we see and how it looks And this here is the actual uptrend that we and how it looks. So there are times where you may believe that the market is getting ready to go short because it traded below a low that was somewhere inside of here. And now you're trying to take a short position from here to go down. And what does the market do? It goes higher, up above there. There are times where you believe that there's some sort of entry in here to trade higher because some imbalance that might have traded through the high, and then price digs further down into that previous zone back here, right? And then it actually moves out and trades higher. So this is, again, helping you to find an area to get in, or the highest likelihood of where you can get in, reduce your risk, and then trade in the direction of the trend or counter trend, right? There are some counter trend trades that we end up in because we're not necessarily paying attention to the higher time frame. We're looking at the lower time frame and the lower time frame opportunities. And while the lower time frame may give an opportunity of a structure break, structure breaking on the lower time frame does not mean that price is reversing, right? So when we talked about the overlay of this, as we are heading down, what we can see is the market trades down, right? And then goes to put in a high, an internal high, and the market trades down again, right? So on the 1 minute, we are seeing this high get broken. We are seeing price tap back in to trade higher, but that does not mean that it wants to go and take out this high right here, because the larger time frame, that the red line going inside of there, trading down, the larger time frame is still bearish, right? It's still trading down. So the little flip that you have inside of here is just allowing you to take part in the retracement to potentially continue down again. The only time that you'll see price begin to trade higher and you could have conviction that we're looking to trade higher is when the higher time frame high is broken, right? Because the higher time frame controls whether the market goes higher or lower. The lower time frame just facilitates that move higher or lower. So the lower time frame has a specific order flow that it'll follow. It has many variations of it that facilitates price going higher or price going lower. Sometimes it's through ranges. Sometimes it won't even be through, trending price on the lower time frames. It can just be by impulses. As it's just moving higher, we don't get any of this here, right? We might end up getting something like this. We get a bearish candle here, followed by a ton of bullish candles going higher, like that. Then more bullish candles here that go higher, like that. So while we think that the market has to move with these highs and lows that are being created, there are times where it won't even create anything substantial to pull back on. It may just be impulsing higher because that's the current condition of the market. That's what's currently happening. It's just moving with strength, moving with speed, moving with momentum. There's just a ton of buying that's coming in that no one's really selling out of position, or the value of whatever the stock is or the crypto is, it's just moving higher. But there are times where we have the same thing on price being bearish, right? You end up having this high put in and you think that that's a pullback getting ready to happen. And what does the market do? The market just continues to trade lower, right? Just continues down. And it's just dumping. We've seen that in over the last week or so, right? Where we just continue to see the market dumping lower and lower. And out of nowhere, we might end up seeing the market do this. We might end up seeing it start to push, and maybe, it pushes a little more right here, right? Starts to push. And then what occurs after? Now you could have more bearishness step back in and move us lower again, like that. So while we understand that it can move in pullbacks and continuations, right? It builds on market structure trading up. It's not all the time that the market gives us those conditions that it will cleanly build structure as it's trading in the direction that it's trading in. So the models are created to show us the subtleties of things that we may need to see, to where while we might be expecting price to go back into this previous range that's right here, what the market may just do is trade back up and stop right here and then move lower, right? So now it didn't trade into any of the levels that were placed inside of there. We put our fib around there, it didn't hit anything in there. It just hit something right at the bottom of here, and then we saw it trade lower. This is going to help us to be able to time better entries, but it needs to be rooted in structure. Because when this happens here, this little pullback right here, when it occurs and it begins to run in that direction, it's still inside of a zone. It just may be a higher time frame zone that's somewhere back here that it actually hit and started to impulse higher. Or you might have something here, right? We might have taken out some low right here, and this traded back into the zone and then moved down. Or maybe the low was up here and there was some sort of imbalance that was here that it hit and then it traded into the other direction. There's many different variations of how price can tap into something and move away from it, and you can find an opportunity on it, or you can wait for it to show its intention to continue the trend that it's in. While people anticipate the market going up and the market going down like this, there are other times where we have this range that's here, where the market now is not delivering any highs and lows for us. It's just actually trading back and forth. That range we've already discussed in some of the mentorship videos. And as you guys go through the mandatory materials section, it'll explain that range for you. So this is when market structure is not structuring, right? It's just trading back and forth between, two levels that might be there, two zones that are there, and you don't know whether price is going higher or lower. So when do we consider something a validated high? When do we consider a validated low? That's these highs and these lows. So this low is validated because it showed signs like this here that it's ready to pull back with the closure that happened on the way up, right? So that's a validated low. This high is not considered a protected high as of yet until it gets back below this previous low. And it needs to be a body closure through there. So what do I mean by that? So this is the market moving higher. And what we see here is this is the up candle right here, right? We get a body below the wick of that up candle, or the range of that up candle that's there. We draw it out a little better. We get a body below it here, right? So now we see prices continuing down, right? And what we need to see is a body that trades up above a bearish candle to move higher, right? But what did we say about that? We said that we need to see it happen at a specific level. So while we can get this, where we get that closure up above, price can go back below again and then trade higher. Now, you might have taken out a position to go long here, and you placed your stop behind this low, and then it traded down and stopped you out, and then actually went the way that you had it going. So when you're trading and you're taking entries at the 50%, as we mentioned, your stop may very well be at the 70, or your stop may be at the low. You might be targeting a 1-to-1, you might be targeting the high, or you might be targeting something else that's further up above, right? The way that you reduce your risk inside of this is when we see this occur, where we put in that high, we put in another low, and then we trade up above the high right here. If your entry was at the 50% of it, and we got up above the previous high there before making it to this high, this entry here would already be at break even. The minute we traded up above this high here, that means that price should not want to continue back to your entry here. What we should see is the market trade back into this previous range here, and then we should see the market trade higher from here, and now it's moving back up. So you can find an entry here at the 50%, or you could wait for the flip that happens there and find an entry here and place your stop behind the low here, because this low should be protected. Or you can buy stop your way into the momentum, right? By stopping the down candles that are trading higher. That's like this candle above up here that we talked about. This would be a buy stop. So this would be where you're anticipating price to continue higher. You're anticipating price to continue higher, and when it trades below that low, up here is where you could look to take an entry with your stop, not this large, but with your stop behind the down candle's low for the market to move higher. So the thing that we look for are the swings, because the swings that will simplify it for us. We don't have to pay attention to a lot of the detail that's happening inside of there. We'll just wait until price taps into the previous range of a swing, and then we'll anticipate a one-to-one coming out of the swing, or we anticipate price to trade back to the low from here, or back to the high when it taps into this zone going higher. This is the thing that we're often looking at, the swing count. We want to see price give us 1, 2, 3, 4. Now there's potentially a fifth and a sixth swing that occurs before price begins to do what? Now turn the other way and create structure back to the downside, right? Like that. But just because we get 4 swings does not mean that we should start looking for short. We should wait until the market shows its hand to us, where the market can let us know that it's looking to trade in the opposite direction. How do we know the market is looking to trade in the opposite direction? We understand that based on the break here, right? So that means that if we got up here, the same thing that we need to see happen up here would be the break. We would need to see price go below it here, right? And then now begin to trade back down like that. This is how we get that break below. You see price taps back into the previous range here, and then now it continues down. You see it go back into the previous range again here, and now it continues down. So that gives us the intention on whether price is looking to continue higher or lower. Now, with the swing count, we have to understand that while it facilitates order flow based on whatever it is that price is looking for, it does not necessarily mean that we should be looking to counter. For me, I stopped trading after 3 swings. I stopped continuing after 3 swings, right? Trading continuations, because there are times where on the 3rd swing, I'm trying to take an entry and I've been liquidated. I've been stopped out. So that's a part of my plan. But for you guys, and whatever plan you have, whatever plan you develop in your own back testing time and based on what you see the most, you should utilize the 4 to 6 swings, unless you start seeing that there's a possibility that there's something else you could incorporate. Maybe one less swing, maybe one more swing, maybe a range after a particular swing. You want to find that yourself and rely on that when you're trading on your own. I'm going to bring you guys to a particular area in price that I was trying to explain earlier in the group. And this is where we have pound CAD, right? It's a Forex pair. This is something that I've been trading over the last couple of weeks or so, maybe almost a month now. I've been looking at this. And I had price trading up to here, and I wanted to see price continue down to here, because I had a weekly area down there that I was looking for price to go and tap into. Now, monetary policy and many other events tend to move the Forex market. So anything can happen in monetary policy globally that would end up, causing your analysis to, fail. That's okay. But what we see here is when we got up here, I was telling some of the group and premium, just letting them know while we are up here and at that area that I was expecting price to reject from, I'm not looking for a short yet. I'm not looking for a short yet because we have not taken out any lows at all. Price has not given us any type of confirmation to say, okay, yeah, we're ready to go lower. We're ready to reject from the little box and squiggly line I have to the left. So what did we end up seeing? The market just move higher, continued to trade up above. How many swings is that? I'm already counting 11 swings as we're making our way up. But I'm not looking to take a single entry going the opposite direction unless I understand that it's a counter trend, right? I'm at liberty to take those, but I need to trade it as a counter trend. I'm taking profit as a scalp. It's not going to be a move that I'm holding to look for any low to get put in because it's not giving me any confirmation whatsoever to take the trade going back the other way. So as we mentioned here, we talked about how the highs and the lows, right? Here's a high here, and we put in this low. What did we end up doing after we took out the high? We traded back into the previous range here, and then you see us continue. Back into the previous range, we continue, right? Back into the previous range. I see price wicked below that low, so that's not structure broken. Sometimes we can just trade down, take a low by a wick, and then continue higher. But it traded down and then continued higher. Back into the zone, continued higher. Back into the zone, continued higher. And now we get this impulse here that it's not going back to zone, right? Now it's just trading straight up. This swing count here and us continuing to trade higher just lets me know that the higher time frame is at play. I can't continue to count these swings and hope one of the swings are going to reverse. What I actually have to do is go to the higher time frame and see what's going on the higher time frame. So if we go to the daily, what we see is this. This is just nothing but, remember what I said? Those green candles that can just continue up, those red candles that can just continue down. This is nothing but that. We see based on the daily time frame, just a ton of green candles making its way up. Like I said, it wicks below the low, trades higher, right? But then what? The market now moves back the other way because it tapped into the higher time frame zone that's there. I told you this is always coming out of something to the left on the higher time frame. But what does it do after? Put in a series of red candles and then just nothing but green candles on the way up. It's just continually making its way up. So why would I think that my little hourly candles in here, my 15-minute zones in here, my hourly swing count is going to matter if this is a higher time frame move at play? That swing count should let you know if price is not turning, that the higher time frame move is occurring. And when you get that higher time frame move occurring, you want to wait until something on the higher time frame is taken in order for you to consider counter trending. That does not tell you that up here is where the market is going to go back down and now take out this low. You need to see some consolidating that's happening up here to support the market now turning in the other direction. The consolidating is letting you know that the buying has ran out and now the market likely is shifting to the other side. That's what happened up here. We had the consolidating that was occurring up here and then it shifted to the other side, right? We had the consolidating that was occurring up here and then it shifted to the other side. So this is what I want you guys to understand with just the basics of market structure, is that you can have zones that price continues to create and not turn around at all. You just have to understand that that's when the higher time frame ends up being in control. So when we see that higher time frame in control, we have to let that higher time frame move play out. We cannot try to be a hero and turn price around with our penny lot thinking that price has to respect the drawing that we put there. It does not have to. So now we're up here. right? And because I understand this is a higher time frame move playing out, what I would have to do is go back here and look at what potentially is happening up here, which would lead me to what? The weekly or the monthly. So now these candles are looking a little better. They're looking, not as much fuzziness that was occurring in there, right? Not the little tiny swings that's making its way up. It's not a lot of noise now that's been silenced. So what we're actually looking for is we see this here, right there. We get that closure below. And this is just the same thing as the zone that's up here. So now there's the possibility that I understand that price could potentially go to 1.89900 on pound CAD before finding some resistance to turn around. So what does that mean for me over here? That means that even if price dips back the other way, I'm looking to continue long until it's met its target. The target could potentially be that 30%. The target could potentially be the high that's right there. It could be looking to sweep that wick, tap into the 50, and then trade the other way. You could target the 1-to-1 on the zones. Now I have from here at 195 all the way to 181 to possibly find shorts on the downside leading to where I believe the short target could be. So this is the crux of what market structure is, the DTFX way, and how we find opportunities. Now, over time, you guys are going to learn how to incorporate models with this. You guys are going to learn how to be able to properly time some moves where you can buy stop and scalp a little bit off of it and pay yourself as you're learning to continue to refine what it is that you're doing and master it, right? But it's baby steps. So the very first thing that I told you guys to consider, the most important thing, is your swing count. And why is that? Because you're going to see closures happening everywhere. But if you're trading in the direction of the swings being made, it's a lot easier for you to be on the right side of the market, or it's a lot easier for you to anticipate a potential reversal that's occurring if you have your swing count in view. So many of the videos that you guys go and watch in the libraries, you'll hear me say when I come on, okay, guys, how many swings do we have here? Let me just count and see what swings we got. And then I'll make a decision based on that. Or if I don't see a decision as of yet, or maybe the swing count has not matured yet, I'll wait until that does happen. Will there be times realistically where you're waiting for another swing to occur and then price just breaks and goes the other way without you? Yes, absolutely. But you can't FOMO into that. You have to make sure that you have a plan for when the third swing isn't formed, the fourth or fifth swing doesn't come in. Price only gives you 2 swings and actually reverse. You just need to go up a higher time frame and see what's potentially happening. So this is going to help you guys to add some stability to your trading and, give you guys those dreams that you have when you first started doing this, right? It's going to revive that, resuscitate that. But it's all on you and your plan and your discipline and your ability to execute based on your rules. That is the thing that's going to save you. That and that alone. Not me, not any signals that I give, not what somebody else is doing. It's all on you. No matter what happens to you in life, if it's good, if it's bad, it's you. Take the blame and move on, right? Build back better, right? Or whatever they said. You want to make sure that you make yourself great again. Whatever slogan you want to use for your life and your future, right? Reinvent yourself, but make sure that you do it within structure and within rules and within a plan. So this is market structure as we know it.